Hello, everyone, and welcome to today's webinar hosted by McClinic & Associates. My name is Dave McClinic, and I'll be your moderator. Before we begin, I would like to thank everyone on this call for all you continue to do to support students. We've known that post-secondary institutions are persistent and demonstrate grit, but your efforts over the past year has reinforced just how resilient and resourceful schools are. Thank you. During today's webinar, we will be covering a wide variety of topics as they relate to the Higher Education Emergency Relief Fund that was created by the CARES Act just over 1 year ago. We're sharing this guidance as part of our vision to be the thought leader providing consulting and compliance solutions to post-secondary institutions nationwide so that schools can focus on changing their students' lives. As you can see in the outline, we will specifically be covering a few topics, just summarizing the time frame for the expanded uses of the HEERF institutional grants, hopefully clarifying some of the guidance recently issued on determining lost revenue, and then finally reviewing the reporting and the claiming requirements for the HEERF funds. Before we do get started, I have a few housekeeping items. First, we're excited to use a new webinar software that will allow more opportunities for engagement during the presentation, especially being able to post polls. We encourage you to participate in the polls that will pop up from time to time throughout the presentation. These polls will allow us to bring you the most relevant content in our webinars, blog articles, and help frame today's presentation. Also, please feel free to ask questions within the webinar tool in the panel to your right under chat. We do anticipate a large number of questions today. Please know that we will be actively organizing them as they come through. If questions can be wrapped into one, we will likely combine them. We will address as many questions as possible, either during the presentation or upon its conclusion. We will also be recording today's webinar, and the recording, along with today's presentation, will be made available in the next few days to all who are attending. We probably all believe that after a year of dealing with COVID and processing HEERF funds, things would be pretty stable. Clearly, that has not been the case as guidance continues to be updated and new rounds of HEERF are being provided. There's a lot to try to follow, which can be hard for financial aid departments to do, no matter how big or small. We work to stay focused on the updates and to provide timely information about the most impactful changes via our blog, the McClinic Minute, and by posting on Facebook, LinkedIn, and YouTube. To receive these updates, you can sign up on our website or follow us on Facebook or LinkedIn, or please subscribe to our YouTube channel. The McClinic Minute has a category of articles specifically related to COVID-19. In addition, we've created a resource page on our website that houses our previous webinars along with infographics we hope you will find helpful. In addition to HEERF, these resources cover the Paycheck Protection Loan Program, preparing for the new lease standard, and other topics. Finally, our presenters today are Mike Weary, the director here with McClinic & Associates, and Chris DeLuca, an attorney with DeLuca Law. Both presenters have been focused on HEERF over the past year, working through regulations as they have been enacted and spending significant time discussing examples and interpretations with a variety of schools and industry contacts. If there are people who have spent more time on HEERF than Mike and Chris, frankly, I feel sorry for them. They have a lot to cover, and I don't want to take up any more time. And with that, I'll turn it over to Chris.
Well, thanks, Dave. So I want to just start with talking about kind of a summary of where we are and how we got here. So we're actually into year 2 of HEERF. I mean, who would have thought a year ago that we would be talking about not just HEERF 1, but HEERF 2 and now HEERF 3. And so we're going to talk a little bit about each of those and kind of where we are with that. So with kind of what's happened over the past year. So it was over a year ago today. So back on March 27th of 2020, Congress passed the CARES Act. And so the CARES Act was their first effort to provide relief to institutions of higher education. And so as I'm sure you all know, but just to make sure we're all on the same page, but as you all know, so that first grant, there were 2 parts of that. There was one part that was a grant of funds to be used for student grants, and that money was a pass-through essentially for institutions. All those funds were to be distributed out to students, and so schools had to develop and design a plan for how they were going to administer that, how they were going to allocate those funds to students, but essentially making sure that those funds made it to students. And then there was an institutional piece. And so there was another piece of funds that was given to schools in order to combat the costs associated with coronavirus. And so, and that's really what we're going to spend a lot of time talking about today. And Mike's going to get into more of the detail on that, because for the past year, there continue to have been questions and continue to have been changes as far as, well, what does that mean, costs associated with coronavirus? The student piece of it has been fairly consistent, I think, from schools. And I think, the understanding of how to distribute those funds and the idea of having a plan and the idea that there was a set amount, a minimum set amount under HEERF I that schools had to distribute to students. And so understanding, okay, if my school was allocated $50,000 for student grants, I had to make sure, and I have to make sure, that all $50,000 made its way into the hands of students. But then there was, under HEERF I, again, if there was a $50,000 grant allocation for students, you would have got a matching institutional grant. And that's where a lot of the questions have been, as far as, well, what can we use those funds for? How do we document the use of those funds? And that has been expanded and really expanded greatly even up until March 19th. That's when the department issued the latest guidance on the use of the HEERF I funds, the institutional piece of that. And that guidance carries on to HEERF II and HEERF III. Now the challenge, so HEERF II is related to the Coronavirus Response and Relief Supplemental Appropriations Act. We kind of refer to that as CRRSA. That was enacted at the end of December, and for proprietary schools, there was a grant of funds allocated to proprietary schools. The issue with HEERF II is that proprietary schools can only use those funds for student grants. So there's no institutional piece. Now, for private nonprofits and for public schools, they were granted institutional funds, so they got an allocation of money that, if they choose to do so, they can use those funds for institutional purposes. But for proprietary schools, it's limited just as funds that can be distributed to students. And then since then, we've gotten the American Rescue Plan, or ARP, that was passed just less than a month ago. And those funds, again, as it relates to proprietary schools, are limited to student grants. And so those are the big differences between HEERF II and III as compared to HEERF I. The other big difference when we're putting the plans together, when you're looking at the use of those funds, is that under HEERF I, with the student piece of it, again, there was the mandate that you had to distribute the funds to students, but schools were given a great deal of flexibility as far as how they decided to do that. And so some schools did a need-based analysis. Some schools just said, if I've got a $50,000 grant and I've got 50 students, I'm going to give $1,000 to every student. And that was generally acceptable under the guidance that schools had related to HEERF I. HEERF II and HEERF III is a little bit different, even with the student piece of it. So for proprietary institutions that don't have any institutional grants, you still, when it comes to the student grant, one of the big changes has been that you have to prioritize distributions to students with exceptional need. Now, the question is, what is exceptional need? Again, there's a great deal of flexibility there. The department references Pell Grant students as students who may have exceptional need, but then also goes on to say students don't have to be Pell eligible in order to get grants through HEERF II and through HEERF III. So those are some of the big changes with respect to those different grant allocations. So the guidance, as I mentioned, the most recent guidance from the department was published on March 19th. And that included a summary. There was a notice of interpretation that went out to schools, and then was also an update of the frequently asked questions. So throughout this whole process, so starting a year ago when the department published its first guidance, that guidance has been generally in the form of frequently asked questions. So the department will pose a question, and then they'll answer their question. And so with that, so they've updated that through March 19th. And one of probably the most important piece of guidance that came out on March 19th was that they created a new frequently asked questions that relate specifically to lost revenue, because that was one of the big changes. So what happened with originally under HEERF I, there was a limitation as far as what those institutional costs could be. So there was this idea, again, that you can use the institutional funds to cover costs associated with coronavirus. But the way that the grants were allocated, you were not allowed to use that money for lost revenue. So that was one of the concerns. And a lot of the schools, the biggest cost that they had associated with coronavirus was revenue that they lost. And so what Congress did with HEERF II is that they expanded the use of that and said, okay, here's the thing. Now, with HEERF II, we're going to let you, if you've got any HEERF I money left over, any institutional HEERF I money, and then again, for the private nonprofits and publics, if you've got HEERF II and now HEERF III funds, institutional funds, we're going to let you use that money to cover lost revenue. Okay, that's great. But the original interpretation of that was, well, we're going to let you use it for lost revenue, but only from the starting point of when Carissa was passed, when HEERF II was passed. So that was December 20th of 2020. I'm sorry, December 27th of 2020. So then it became a challenge of, well, okay, that's great. We can use it for lost revenue. But here's the thing. Most of our lost revenue happened in March and April, May and June of 2020, because that's when, that was the peak of the pandemic. That's when we had to close our schools and figure out what we were going to do and how we might transition to, some type of a hybrid education or things like that. So that's really where our lost revenue hit. So, so it really limited the ability or the benefit of this expanded interpretation to allow institutions to use the institutional portion of their grants for lost revenue. So what we've got now is, as of March 19th, new guidance from the department coming back and saying, we've thought about it again. So again, this is, as Dave was saying, these interpretations and guidance from the department continue to evolve. We continue to get new guidance and trying to stay on top of this. So the latest and greatest guidance from March 19th says, we've thought this through, and we're going to let you use, we're going to interpret this expanded use of institutional grant monies. The idea that you can use it for lost revenue, and we're going to let you go back all the way to March 13th of 2020. That's the date that the national pandemic or the national emergency was declared related to the pandemic. So that will now allow you to use your institutional funds to go back and, if you still have some that are unused at this point, and looking at ways to how we might be able to allocate those funds, that we can go back and look at to see if there was any lost revenue going all the way back to the beginning of the pandemic. And that's important, because if you've got any remaining institutional funds under HEERF I, we're getting up to that 1-year anniversary. So one of the things under HEERF, one of the requirements was that those HEERF I grants, those student grants and those institutional grants, you had to use those funds up within a year. And so we're coming up on that year. I mean, we're already 1 year past when the CARES Act was enacted. Most schools probably got their grants. The grant effective date is probably somewhere around May 1st. Well, it's April 1st now. I mean, we're getting close to that. So, now's the time we need to be thinking about, wrapping up those funds and making the best use of those funds, or the eligible use of those funds. So this expanded guidance really comes at a great time as we're trying to, if you're an institution that's looking at having those institutional grant funds and figuring out how you might be able to best, allocate the use of that. So, and again, just we've got as a reminder here with proprietary institutions, again, there's the expanded guidance as far as the use of institutional funds, the idea of covering lost revenue. That doesn't apply to HEERF II and HEERF III, because again, HEERF II and HEERF III, you can only use those grant funds for additional grants to students. One of the other things that the March 19th guidance provided was some flexibility and a little more lenient interpretation as far as as far as some of the requiring schools to get if there might be a requirement to get approval for grant funds. But the biggest thing, I think, and the reason for today's webinar really, and trying to get this information out, is to remind institutions that we're coming up on that 1 year anniversary. So making sure that we've got a plan in place to be able to use those grant funds, before we get, before that year expires.
Hey, Chris, it's Mike, just one comment. We've heard that, in the guidance, it does say schools can apply for an extension on these those funds. I know from talking to some organizations, there have been some extensions approved. we're only a month out at this point, and so we are just concerned at how many extensions they'll get done and approved. And if you've used a lot of your HEERF I, as you'll see, this guidance is pretty lenient. They should be able to, get to go back and get those funds claimed within the next month without having to apply for an extension. So we think that's the best course of action. I'm not going down that path, but just looking back over the last year and figure out how you can use these funds.
Agreed.
And I just want to say anniversary, so our trademark will actually apply when that becomes the accepted terminology for the 1 year end date.
Okay. So again, with the time frame for the expanded use of the grant funds, again, you're allowed to go back to March 13th of 2020 to recover those funds or to allocate the use of those funds. And so that's important. And one of the important things, and I think Mike's going to talk a little bit more about that as well. Here we are on April 1st. For HEERF I, the next quarterly report is going to be due April 10th. So you've essentially got to the end of next week to allocate the use of funds through March 31st of 2021. So if we're going back and if we're going to use institutional funds and go back in time to allocate, our unused institutional grant funds to cover those lost revenues, we want to capture those on that report that's coming up. So again, time is really of the essence from the standpoint of one, we've got the 1 year anniversary coming up. But then we also have the reporting anniversary coming up, and so making sure that we're covering those bases. And as I mentioned before as well, so with the guidance too, the department waives the requirement for prior written approval of some pre-award costs. So with that, I am going to, I guess first we're going to do our first poll. So the question for folks is, have you used all of your institutional grant funds under HEERF I? If you used all your grant funds, then obviously click yes. If you still have unused or unallocated HEERF I institutional grant funds, click no.
The answers are coming in, and we'll share it in just a moment when it appears most have been received. I don't want to spoil, but it seems to be close to equally split as they come in.
Certainly still a fair number of schools that haven't, though. So hopefully
it's interesting. Yeah, I would say well more than half of the schools, for the folks who are participating in the poll, well over half are saying they still have institutional funds available.
Yeah. And so while we're waiting for that, Dave, there's not a slide on this. I just wanted to make a couple quick comments. For many of you may know, there's an audit guide for these HEERF funds that came out yesterday, specifically from OIG for the HEERF funds. For any of the nonprofit schools you fall under the compliance supplement, and there was an addendum issued in December of 2020, so this doesn't apply to you. We've not digested the 56 pages of the audit guide in detail, but just very quick points to keep in mind. And we will be sending out more detailed guidance on it in the next week to 10 days, hopefully. The audit will be required within 120 days or whenever your annual audit has to go in. So if you're a 12/31 calendar year or you're June 30th, 20, you've got 120 days from March 31st to get this HEERF specific audit in. It does appear that the audit is by OPEID number, and there's a dollar threshold. So a number of schools who got the aid may not have to do an audit at all. And it doesn't appear to be any minimum sample sizes in the guidance, kind of like the compliance audit for financial aid. It looks like the sample sizes are up to the auditor. So those are the positives. The things to be careful of is that any errors, any non-compliance has to be reported, similar to the proprietary compliance audit guide. So even if it's an immaterial error, that would result in a finding. And there's a lot of language in the audit guide which I think will apply a lot to the institutional use of the funds, referring to the Federal Register, the federal standards, to CFR 200. What are the procurement procedures? What were the policies to approve the use? Did you have to have competitive bids? Were you allowed to have emergent, grace period from the emergency and not go through competitive bid processes? So I think you really need to look at the audit guide and be certain that you've documented in accordance with the federal regulations, the policies and procedures for claiming the institutional piece. I think that has very little bearing on the student piece. And those are some of the things we're going to be highlighting here in the next week or 10 days as we get additional guidance out. So.
All right. Well, looks like,
Dave?
well, Dave, I don't know if you want to issue the poll.
Yeah, it looks like we can't push the poll results out. As I said, this is new software, but it looks like it's about 60-40. So 60% of the schools have not spent 100% of the HEERF I institutional money, which means hopefully today will be useful. And I'm sure a big part of the reason could be the uncertainty about how do you define lost revenue and what are the acceptable uses for the HEERF I. So with the 1 year coming up for a lot of schools, hopefully what we're going to review will be timely.
So thanks, Dave. Thanks, Chris, for kicking us off. And I'm going to talk a little bit now about the expanded guidance on lost revenue, because I think this is kind of the crux of the department's most of the information they issued on March 19th. As a step, go ahead, Dave.
I'm sorry. We are going to be sharing right now a handout as well, which is the actual document from one of the links we had before. It is the FAQ related to lost revenue, because we do reference some of the specific questions in the presentation, and this will allow you to read through the question. Sorry, Mike.
No, thanks. And so stepping back, I think the lost revenue guidance was, I think, really pleased when we saw it. It's the department provided this guidance that it's accessible to you. And it certainly was more lenient than I had anticipated. And again, this guidance is applicable all across the sector. So no matter what type of institution you are, our understanding is that you can take advantage of this lost revenue. And so it's good. It's kind of wishes the department would have got it out sooner, but I've got to give the current administration some kudos that they got it out and it's benefiting the entire higher ed sector. I pulled a couple things from question 3, that FAQ, things that qualify as lost revenue, room and board, enrollment declines. There's a laundry list of auxiliary items where they talk about bookstore and parking, dormitory, other operating revenue. I mean, when you have other operating revenue, that seems to be pretty much a catch-all for just about anything you do that's related to the your institutional purpose, that it seems like you would be able to fit it in there. There was one item that caught me off guard and it surprised me. They said you could use lost revenue for unpaid student accounts receivable and other student account debts. Now, this is not the same. If you remember in the CARISA bill, where they expanded the usage of the student portion, they're allowing the student to apply their disbursements to tuition and fees if you get the student's attestation and blessing to do that. This is different. This is just using the institutional funds for student AR and other student debts. There's no other guidance or explanation on this item in the FAQ. So I'm a little hesitant to kind of refer schools and bless them to do this. I think there's enough other ways to claim lost revenue that's easier without having to use it for unpaid AR. I think maybe the optics of it, for me, it makes me a little bit uncomfortable. And so I think we're kind of pointing schools in other directions at this point, unless they have further clarification of this item. But basically, if you've got less revenue, I think you can look at question 3 and fit it into one of their categories. So the CARISA Act didn't specify, when they came out with CARISA on December 27th and they said, hey, lost revenue now falls under, the original HEERF 1804A1, they didn't say how you could compute the lost revenue. But question 9 in FAQ kind of gets into the detail. What they've given us in question 9 is saying, listen, these are ways you can figure out how you had lost revenue. Is it a year over year? semester over semester, 3 to 5 year combined average. I think the key with any of these examples departments provided is be certain that you're consistent on the treatment. And I think from an audit standpoint, that's one of the things we're really going to look at. If you're going to claim lost revenue for a 6 or 9 month period of time during 2020, your baseline should be that same 6 to 9 months in the prior year or the prior year average. What you don't want to do is have a baseline of 4 months and then extrapolate that for 12 months in the current year. You want your lost revenue period and your baseline period to be the same timeframes. So one of the ways, Chris and I have talked about this is thinking about what's your school operating cycle. If you're a traditional school, looking at this on a semester basis may be the best way to do it. If you're maybe a non-traditional school that's running on a clock hour or non-term, you may want to look at this at a payment period or an award year or some type of quarterly basis. We think a month is a little too short. There's too much fluctuation in a month, especially for non-term schools. Things vary by month because of how your students progress. So think through what your operating cycle is and what aligns, what makes sense in your case. If you've got different revenue streams you're claiming, their baselines could be different. So if you're a traditional school, you may say, well, tuition was down from my fall semester, so my baseline would be the fall from the year before. Your auxiliary revenue could really be the summertime. So your baseline for the summer would be the previous year. So I think different revenue streams can have different baselines. Just ensure you're measuring the lost revenue to a consistent baseline from a prior or multiple prior periods. Just a couple reminders, some specific sources that are not reimbursable, marketing, sectarian, religious, that's pretty normal. Just a reminder that they haven't changed that, nor was that expected. And the second thing is you don't want to double dip. Many institutions probably got the PPP loan that's on today that's being used for salaries. I haven't seen a lot of schools claim salaries through the HEERF funds just because of the uncertainty around it. But if for some reason you really did hire someone new, you had additional overtime cost, be certain those costs you're claiming for HEERF aren't also in your PPP period. You can claim them after your PPP loan period ended, but don't double dip and claim them for the same time period. I think that's just kind of a logical thought. If it seems uncertain, then don't do it. Also, if you happen to claim rent, if you were closed and claimed lost rent, you felt that was allowable, I would be careful if you're going to claim lost revenue for the same month, or maybe take the rent out possibly if you claimed it for part of your building. Again, that could be seen to be double dipping if you're claiming an expense and a revenue for the same time period. So kind of map out the lost revenue and see what else you had for those existing periods, and be certain that you aren't kind of using that same cost and claiming it in multiple locations. And so now, another poll, Dave.
New guidance.
I'll give it a second here. And while the poll's going, I think for most schools, a lot of schools we've worked with, they had not claimed all of the HEERF I because they felt they had run up on the expenditures they could, and the lost revenue guidance really gives them the opportunity where, especially April, May, June, they really struggled and there was a big dip. Even if the rest of the year was maybe consistent, you still got at least a quarter in there that you really experienced lost revenue.
Right. And while it's coming in, we did get a couple of questions related to lost revenue we might be able to cover briefly. So one, and I don't think you specifically mentioned this, Mike, was about using it for clinic revenue as well.
Yes, and that's one of those I'm going to get to. So I'm going to go through a few examples, and that's one of the specific ones I've got. So
all right, perfect. Yeah, we do have a lot of the answers in, and it appears I'd say roughly 2/3 of the schools are planning to use the lost revenue guidance. So I guess hopefully I can provide some comfort to people that you're not on an island when you're doing it, and hopefully again some of the timeliness that we're reviewing today.
So we're going to get into a little bit of our interpretations of the lost revenue guidance. So keep in mind 2 items. If you go to the very last page of the guidance, they walk you through a few examples, and they're going to use a traditional school with the June 30 year end for their examples. And I think the guidance is good. I think it does look on surface that you can literally just take current year numbers versus prior year numbers and be done with it. I think we want to be careful not to make it quite that simple. Question 5 really does say lost revenue was due to the pandemic. I think in your support, you still need to have documentation to say revenue was down because of the pandemic. If you were closing a location before the pandemic and you were budgeting a decrease at the location because of the closure, you certainly can't claim that decrease in revenue, at least from what your budget was, as part of the pandemic closure. I mean, you can't just say, well, we knew our enrollments were down, we're cutting this location, we're cutting this program, and we're just going to use the HEERF money now to cover it. That is not the intent. So I think you've got to be careful if your documentation doesn't support why the pandemic caused the decrease. And also they say in question 10 to maintain support for your calculation. They talk about rationales, your calculations, the methodology, the data. So I say don't take the last page of their example and cut your data too short. I don't think you need a laundry list of 1,000 students computing the exact revenue loss for every student, but you need to have a budget's support. What was your enrollment trends? If you're clock hour school, what was the change of your hours or credit hours school? Maybe your credit load was down. I think you want underlying detail, whether it's by semester or maybe by your cohort start for a non-term school, to support this is why the numbers are down. It's the financials may have the change, which may be the number you're going to claim, but there's support behind that. Go ahead, Chris.
One of those things, I mean, you mentioned clock hour schools. So, for example, if you're a clock hour school where you were closed by local or state mandate, or I know some states had issues where with transitioning to distance education, but for clock hours, you could only clock 15 hours a week or 20 hours a week or something like that. I mean, that would seem to be, corroborating evidence. So you've got the data from the financials, and then to say, oh, and during this time period, our students, we earn revenue by the number of hours our students attend, and they were limited on the number of hours that they could attend because of these various considerations. So, that may be an example of something you could use to support.
And I would just add a limit on students, right? So if social distancing meant you had fewer students in the classroom or that could be taught at any one time, that would also be good documentation.
Exactly. And so to think through a couple examples, and the first one I had was clinic revenue. And one of the things I mentioned there is have your state and local stay-at-home orders and restrictions. I think it's good to school to have what it is. I mean, I don't remember what PAs were, let alone where all my clients are located. So have that documentation. I think that will go into exactly what Chris and Dave were talking about. Clinic revenue, I think, fits right in the auxiliary services. I mean, they say other operating revenue. To me, clinic fits there exactly. I think this is the easiest one. The clinic was literally closed or operating at partial capacity. I think this is one of the easiest items to claim. Clinics, your baseline for previous years is pretty consistent. And what I mean by that is for a 12-month period of time, your clinic revenue tends to stay fairly static, what I've seen over years, because you only have so much clinic space. So unless you add or change locations, the clinic volume doesn't change a lot. Yes, certain months are higher. December's higher. Maybe time around the Easter holidays, clinic volume's higher. But year over year, those months stay consistent. December is always higher. Other months are lower. So comparing clinic revenue to a baseline of the previous year or previous year's average seems to me to be sufficient support to claim it, along with all the stay-at-home order and the restrictions. I don't know if you have to do a whole lot else for clinic. I mean, I've seen clinic volumes are running about 30 to 40% of what they were before. So to me, I think it's one of the first things to do. Again, watch rent. This is one of the ones, if you claimed rent and your clinic was closed, I wouldn't double dip. I would maybe take the rent, subtract that from any lost revenue calculation, so you're not claiming the same dollar twice. And then just thinking about 90-10, thinking through this, the guidance department put out last fall, not in this guidance, but what's called their rolled up HEERF guidance, indicated that as of now, HEERF 1 is not Title IV money. So right now it's not in the 90-10. We're not going to get into the changes in the ARP Act that are coming in the future, but right now HEERF is not in the 90-10. So it's not part of your numerator. However, you don't get to count this in your denominator either. This is not revenue from the services being provided. So it doesn't help your denominator to increase and make your 90-10 lower either. So I think it just is completely excluded. So keep that in mind. And then when you're computing this, remember, keep your sales revenue as well. So when I say clinic revenue, we're talking service and sale revenue. I know the sale revenue is not counting in the 90-10, but that's irrelevant for lost revenue. If product sales are down too, it's just like service revenue is what you could claim. Second example is you have a new program, or even think about it as a new location that didn't start. I know a specific school that a location delayed because their accreditation visit was supposed to be April of 2020. Well, that got delayed 6 to 7 months, which delayed the whole opening of the new program to sometime this spring. So I think that's another one that's easy to claim. You've got exact reasons where the pandemic delayed it. You've probably got paperwork from state or accreditors saying they couldn't visit. You have a budget for what that start was expecting to be, which, Sophia, that budget would be after your normal withdrawal or retention rate. And you could compute the months of revenue you lost for that cohort of students. You could estimate it. So again, you have your tuition and fees and your months in your fiscal year and your budget and projected enrollments. You can come up with a tuition for that cohort and to be claimed as lost revenue. To Dave's point, social distancing requirements. If you've got those limitations now that you're teaching only at 50% capacity, I think you can compute what that revenue loss was. That could show up in your clock hours being down. It could show up in less students being on site. Remember, if those students are taking stuff online, obviously maybe the online enrollment has offset the loss on ground, so you haven't experienced lost revenue in total. Don't cherry pick just things. That's where Chris and I have talked and felt you need to be prudent in how you look at this. Same thing, and don't just pick certain months. So it was like, I'm going to pick 2 or 3 months from the year randomly. Well, maybe other months you were increased and you didn't really experience lost revenue. I think you want to step back and look at it and be certain, am I being fair? Am I meeting the intent of what the emergency funds are supposed to do? But again, I think if you really have lowered enrollments and you've stretched out students' education, maybe some are going online, you're teaching a little more at night, but it's not meeting what you did pre-pandemic, I think you can claim that by, again, having your enrollment trends, your enrollment and population reports showing students on ground, lower clock hours, maybe higher drop rates that can go into what the lost revenue is that you can claim. The fourth one I've got is, increased student withdrawal rates. I had a client specifically reach out. They had some retention issues in their hands-on training programs. They had online programs and business programs, which students continued on fairly well. Even the on-ground students continued online, and they didn't see a big hit, but they did with their cosmetology and their HVAC program. So look at those programs. If those cohorts are having higher drop rates, what was the drop rate they're experiencing over what your normal drop rate? That would be the delta you could maybe claim as lost revenue. So how many students were in there? What was the tuition for those students? What would have been their earnings for the remainder of the year? Think about if there's any Title IV refunds you didn't have to send back. As part of the R2T4 process, you got to keep that. So does that consider if that should offset any of your lost revenue? But I think, increase in drop rates because students can't matriculate through and continue at the rate of progression. And, and you could see that in a traditional school as well. You got to be careful. You may have sent tuition refunds back to them, which you certainly should take out of the calc. But I think there's an opportunity there to look at that delta to say, can we claim that as lost revenue? And you should have underlying documents to support what that calculation is.
Another possibility would be if students didn't start classes because they wanted on-ground learning and not online learning, can we claim that as lost revenue? And that would seem like a good.
Correct. Exactly. So if you've got budgets, what you expected to. So remember, any budget you have, make sure it's the budget pre-COVID. Make sure it's not a recasted budget as a result of COVID, because you're not going to have any differential there. So have that budget, and if you've got expected enrollment starts, and then try to have the documentations. Maybe students communicated with you. Keep that as the documentation that says I'm not enrolling. I want to wait, and so they've attended maybe they did start, but it's only 3 months of revenue versus 6 to 9 months of revenue. I mean, that spread of difference, I think you could certainly claim as lost revenue. And or, some said the students maybe didn't start at all or waited to 2021, and that's now pushed revenue down in 2020. So that, again, that's certainly revenue you could claim. So the next step, so Chris, I'm going to talk a little bit now about reporting and claiming. So if you go through the lost revenue process and you say, great, I can claim it. Well, how do I claim it now that I've done the calculations? And so, as Chris mentioned earlier, if you're a nonprofit school, your GAN's probably not expiring, and you've got some extensions that were built into the CRRSA 2 guidelines. But if you're a for-profit school, your anniversary is coming up soon, and I think it's best to try to just get the money spent without asking for an extension. Again, the guidance they put out on lost revenue, they did provide some of this example, which I've got on the slide here, and it was helpful. So let me walk you through this. They've given an example of a nonprofit, and CFA stands for Schedule of Federal Awards. So what the department has said is if you're claiming lost revenue from your July 20 to June 30, 21 audit, you just claim it in your June 21 audit, right? The audit's not done, it's in the current audit period. You would claim it then. Likewise, if you're claiming lost revenue just for your fall semester from August of 20 to December of 20, and you're a 6/30/21 year end, same thing. You're still in the same audit period. You're just going to claim it on your 6/30/21 audit. Here's I think one of the really advantageous things they did. If you've got lost revenue from July of 19 to June 30th of 2020, so in essence, late March of 2020 to June 30, 2020, you can claim that on your June 30, 21 schedule of federal awards, which what they're saying is you don't have to go back and retroactively update 2020. You don't have to change your annual report. You don't have to change your quarterly reports. They're basically allowing you to claim that in 2021 as of right now. So that is one of the pieces of guidance that we found was really helpful. You're not, going back and claim and updating stuff retroactively is just record keeping, right? And that's not the point of what Department of Ed wants you to do. And so our example would be, here's our interpretation. So let's say I'm a calendar year school. I'm a proprietary school and I'm a calendar year. You're not going to amend anything. I'd go back and look at lost revenue from March through March 31, 2021. And if you can claim it, try to get it on your first quarter report that's due April 10th. You may be able to go back and look at 6 months of last year, and that's gonna be enough to use up your remaining funds. So if you can do that before your April 10th report, I would try to do that, because this may not take hours and hours to do, and you can get that on your report for April 10th. You can get the funds drawn down, and it just becomes revenue in 2021, and first quarter. If you don't get it done by then, you still got one more month. I don't know when your anniversary date is, but at that end of April and that's early May, you've still got one more month to get those calculations done. You can draw down the money in the second quarter and you'd report it on your July 10th, 2021 quarterly report. But every day you wait, you're getting closer to that deadline. And again, if it's for a past period, it doesn't matter. Let's get it on the earliest report and you can mark it final, and then you're going to be done with it.
I guess, and what I would like to add to that is your, from an accounting standpoint, looking at lost revenue and doing that calculation. Well, obviously, first you need to do revenue, and to realize with the reporting due date of April 10th, the idea that you're going to have an accurate detail of all your revenue through the first quarter of 2021, i.e. through yesterday, may be very challenging, particularly if, for clock hour school, you have to accrue the clock hours earned by students. You have to, what refunds were made, what students dropped, and you're doing those allocations. The idea that you can have those tight in the next 7 days is probably pushing it. But you should have your numbers already prepared through December 31st. And so I think, what Mike was saying was that, if you can look at March 13th, 2020 through December 31st, 2020, and do the lost revenue analysis based on those numbers, you should have all the data available to do that, to work on that rest of this week to work on that next week so that you can use up your HEERF I institutional grant monies, report that on the report that's due on the 10th, and check the box final and be done with it. I mean, that's really, that would, I think for most schools, I mean, if I were back in my days as CFO of a school group, that's what I would be doing.
And just as a comment, you'll claim the revenue in 2021. There'll be revenue from an accounting standpoint. You report in 21. This will be taxable revenue. The rest of your HEERF money that had expenses, in essence, you had offsetting expenses that you wouldn't have occurred. It was a net wash. Lost revenue won't have an offsetting expense. It will be taxable. The PPP loan was for thousands of companies, nationwide, with a huge lobbying effort to get that to be non-taxable. I don't see that happening here. The taxability only affects proprietary schools. It doesn't affect traditional schools. There's enough other political differences right now, to say the least. I don't think this is a battle people want to fight. So, just realize you're going to pay the tax on it and take the money, net of taxes, and be happy with that. I think that's expending political capital on trying to get it to be non-taxable is just not going to happen. So, nor I think would that be a prudent approach to go down. So, just keep that in mind for tax planning for 2021.
And while we're discussing this,
just
real quick. I think we've touched on it a couple times, but there are several questions about it. Just reconfirming that the due date for the HEERF I reporting varies from institution to institution based on your date on the grant award.
So the reporting doesn't date. The reporting due
April 10th. I mean, but the expenditures.
Yes, correct. It's on the GAN date. So,
yeah, thank you. So it's coming up repeatedly, just to making sure people are absolutely clear. Yeah.
So to Chris's point, if I was in your seat, and I don't have this in the slides, but if I was going to use lost revenue, here's the pecking order I would go down. If you've got auxiliary like clinics, start there. I think that's the easiest thing to claim. Then I'd look for months you were closed, that your location was physically closed. And maybe you didn't even get the teaching online. It took a few weeks. That's going to be very easy to claim. Then I would look at reduced capacity, where you didn't have people coming in. I would then look at delays of starts or new programs or new locations. And then I'd go down and start looking at rate of progression decreases, increase in drop rates. I think each one is a little more work to claim. So start with the easiest ones you can. And if you use it up, then you're done. And Chris and I have talked, if you end up with extra, that's okay, right? If you claim $100,000 in the end and you got 150 of backup, well, that's great for your audit. You just have additional revenue or expenses that you didn't have grant money to cover, but it helps to support that what you did claim should be fine under audit. Yeah.
Well, and one of the things Mike and I have discussed as well is if you're an institution that's used all your institutional HEERF I grant money, you should still go through this analysis because there's an audit coming up, right? So your auditors are the audit guideline came out. And if there's any question as far as the use of your other funds, say, well, okay, then if there's any question about that, well, we also had lost revenue during that period, and here's the backup detail to support that. So that kind of a belt and suspenders approach to making sure that you've got the documentation to ultimately support your use of those grant funds.
Yeah, and again, that maybe would require then, all right, you got to amend some reports maybe, but I'd hope that ED's approach would be if ED looked at it even and challenged it, that they would say, all right, we want to update reporting and reports on your website, but that would not be a huge issue.
Yeah.
So
Dave,
Dave,
I guess one of the things, and I may be getting ahead of things here, Mike, but while we're talking about reporting, so there's the April 10th report. Recognize that the form that the department published months ago for the quarterly reports, it includes categories of various uses of the HEERF I institutional grant funds. And there were different baskets, for lack of a better word, or tranches, or however you want to call it. There were different allocations under the CARES Act. There was A1, A2, and A3, and we don't need to get into the details other than to say, under the original law and guidance, you couldn't institutional grant funds that were categorized as A1 were not eligible to be used for lost revenue. A2 and A3, you could use it for lost revenue. Well, now the department's changed that. Again, we've gotten a very favorable interpretation from the department that says, okay, now we're going to allow A1 as well as A2 and A3 to use it for institutional funds. The reason I bring this up is that if you look at when you look at the form, so when you're filling this out next week, and you're going to post it on your website, you're going to see lost revenue in the A1 box on the form. It's going to be grayed out. So you're not going to be able to put anything under lost revenue for your use of the funds. Now, there is another box at the end called other. And so that's the box where you would have to put this. And now there's also a box for an explanation. So you would include in the explanation that it's lost revenue under the guidance from March 19th. So you would include a description as far as, okay, it's lost revenue and we're claiming it as lost revenue because of the additional guidance from the department. But I just wanted to make sure that you're aware of that. So when you're filling out the form and you see that the box where you would put in the amount of your lost revenue claimed is blocked out, that's because it's an old form.
And Chris, I checked ED's website and their kind of chart. That form hasn't been updated yet, so but that was hoping.
And I would not expect it to be updated between now and the 10th. So
yeah, well, I'll say so. Dave? Oh, Dave, you're on mute. Oh.
Before we get into the just the HEERF II reminders.
And as we're waiting for that, I just want to thank Chris for being here. Chris, as being a former CPA at one time, understands our archaic nuances, and so we've spent a lot of time talking over the last year about the counting and the record keeping. And so a lot of the blog posts we've done, some of that's come out of conversations I've had with Chris. So I would appreciate the time he has had and give him some kudos for some of that knowledge capital.
Well, you're very welcome, and it's great to be able to talk with you and your team about these as we try to noodle through these. Because from the lawyer's perspective, I appreciate talking with the CPAs and the auditors, and when I've had these conversations with clients, talking about it, say, okay, this is our interpretation, but always make sure you go through it with your auditor as well, because at the end of the day, they're the ones who are going to be doing the audit report on this, right? And so we want to make sure that if there's any question about interpretation, that we address that before we do something we can't undo.
And we always say, talk to make sure your regulatory counsel is in agreement. But I laugh about it, but it's true. If us and your regulatory counsel are in agreement, and we think it passes the snuff test, I think you've got a much higher chance of, upon an OIG review or other agency looking at it. So I think there will be scrutiny around it in some institutions more than others. So I think it does not hurt to spend the time and money to be certain multiple parties agree, because you don't want something coming back later. I mean, they're giving a lot of free money that are under different auspices than most of you have used before. So I think prudence is the better part of valor here.
Absolutely. And just moving on, about 70% of the people have applied for HEERF II. We were aware of some people that were holding off because of the uncertainty. And just an update for everybody, we do expect to finish the presentation in the next couple of minutes. We'll expect to stay on until maybe 10 or 15 after the hour, just getting through some of the many questions that have come in, so people know.
So with the poll answer, so again, about 70, maybe 3 out of 4 schools have applied for the HEERF II funds. If you're a proprietary institution, and you want to participate in HEERF II, you need to apply, and that application deadline's coming up. You've got 2 weeks left to make that application. So and I've talked with some schools that had questioned whether they were going to do it or not, and here's my unsolicited advice on that. And Mike, you can and Dave, you can chime in as well with your opinions on it. But recognize that HEERF II is a pass-through. And what I mean by that is, as I mentioned before, all the funds that are allocated to your school under HEERF II and all that are going to be allocated under HEERF III, 100% of those funds need to make it into the hands of your students. So unlike HEERF I, under the CARES Act, where you had some money to cover costs associated with coronavirus, that's not eligible for proprietary institutions. But I think there's a couple of points here. One is that that these funds are going to be helpful for your students, obviously. There's also an opportunity under HEERF II, and again, I would encourage you to talk to your auditors and your regulatory counsel to do this. But one of the expanded uses of HEERF II was that you could have your students with the grants. They could choose to apply some of those funds to any outstanding balance at your school. That was a much broader interpretation than we had prior to Carissa and prior to HEERF II. Now you have to be careful how you do that. You can't condition the grant money on, or the amount of the grant on whether or not the student's going to apply it to their balance. You can't condition their ability to receive it on the fact that they're going to apply it. They have to, even if you've got a student that has a $10,000 outstanding balance and they're getting a $500 grant allocation, if they they have to be aware of and have the right to take the check and not apply it to any balance that they owe to the school. But that's some flexibility, and some schools have taken advantage of it. I know some schools have said we don't want to have to worry about that. We'll just give all the money to the students, and if they turn around and write us a check, that's great. But that's that is a benefit for the institutions if you want to take advantage of that. I also think that there could be some serious PR issues for a school. I mean, because the allocations to the schools are public. It's on the department's website. I mean, anybody can look up how much your school has been allocated for HEERF I, HEERF II, and soon HEERF III grant monies. And again, it's from the idea that if students know that there was money that you could have allocated to them, given to them, and you didn't, I think that could be a big issue for schools. And I also think from the standpoint, this is one of those things that's very hard to measure, but you don't know if you've got a student out there who's barely hanging on, that if they got $1,000 allocation check, maybe that's the difference between them staying in school and dropping. And so, the idea, yes, there's some administrative costs of managing the program, but again, if you're on the fence, again, that's my thought process as far as, and those are conversations I've had with some folks as far as when they ask, well, why should we do this?
Yeah, I would agree, and I've heard from some of the associations in DC who really pushed hard for the money because it would be excluded. I think a large number of people not using it then would look bad on all the efforts that they had as well. And again, you have students who have friends at other schools getting the money, and now your students aren't. It could come back to you negatively in the press if you decide not to expend the money. Even if you don't spend all of it, spend at least a good chunk of it.
Well, and I think the concern would be, especially if you get the written authorization and apply it against institutional funds, how does that look? You don't have to provide that option, right? Like Chris and Mike are saying, just do it purely as a pass through.
Right.
We did have a question related to this, which touches on it, which is HEERF money, the HEERF II. Is it eligible for students who are enrolled in non-Title IV programs?
Yes.
Yeah, and that's in the third Q&A that's out there it's for the public and nonprofit institutions, but the guidance, some of the expanded questions apply to the proprietary as well, from our understanding, where they specifically said non-degree, non-credit, and that's what we've heard from everyone. So I think.
All right, I guess one bullet point down here, and I did mention this before. The one thing, if you haven't done your HEERF II allocations yet, just remember that whatever allocation formula you use for students, there has to be there's a mandate that the distributions prioritize students with exceptional need. What that means, again, as I mentioned before, there's a lot of leeway for schools on what that looks like. And so I would just encourage you, again, as you're going through that, as you have questions, talk to your counsel or talk to your accountants, your CPAs, just to make sure that whatever you're doing, again, you can't just give everybody the same amount at your school, that there has to be some factor of need. And you've got information about that already. I mean, you've got ICERs for students, right? So, I mean, you can start with that. You can have students do application forms or, present, demonstrated hardships, sort of like a professional judgment analysis, if you will, if somebody had a really rough 2020, and I'm sure a lot of your folks had a really rough 2020s, that there's something in your allocation formula to show that there was some sort of a need analysis.
And then we just had a final slide, so I think Chris has talked about on HEERF III kind of already, to keep it in mind.
And one thing I would say on HEERF III is just be thinking about, these are conversations that I've had with other schools as they're putting their HEERF II allocations together, or their formulas, or how they're going to distribute or award the grants under HEERF II. Just recognize, well, you got HEERF III coming as well, and so there's going to be more funds allocated to your school. So again, some schools started with talking with them about putting plans together where there might have been multiple awards of the HEERF II money. So maybe they were going to allocate awards to students who were in school on April 15th and then another award on June 15th. Well, that was before HEERF III. So now with HEERF III, they're going back and thinking, well, maybe we change that. We just do all of HEERF II on April 15th. All award it then, and award all of HEERF III on June 13th or June 15th. So again, just something to think about as you're putting your if you haven't done so already, as you're putting your award plans together, or how you're going to your procedures for distributing these grant funds.
So Dave, I have one comment and one question. It's one of the bounce off Chris as well. if you use up all of your HEERF I institutional funds, be certain you spent 50% on your students, especially if you spent most of it, but you had some uncashed checks. Technically, then you haven't spent all of your HEERF I student money if for some reason you void those. You don't want to end up that you've underspent the student by $1,000 or $2,000 from uncashed checks. Get that money redistributed and sent out if you're going to claim the rest of your HEERF I money. That could be something easy you just miss. So the other thing,
just tied to that real quickly, if you have money you haven't spent, even if you have the HEERF II, you can use the remaining unspent institutional to give additional grants to students. So if students are starting to apply based on need or something else, you could spend the remaining institutional that's been unspent on the students.
correct. You do that
Right.
as well.
Yes, that's right. That's always has been always
Yep.
an acceptable use, that you can use the HEERF I institutional funds for additional student grants. Yes.
So Chris, one question I've heard a couple of times in the last week is if you had unused HEERF I money, student money, and you could use that under the expanded uses of CRISA. That's one of the things you're allowed to do. And let's say you used 95%, but you got 5% left. If you expend that, where does it get reported now? Does it get reported still on your HEERF I student disclosures, or would it go on a HEERF II student disclosure? Because really it's getting dispersed now under a different methodology. And I'm not sure I don't have a clear answer on that. I just was curious what your thoughts were.
So the HEERF I reports, there were 7 data points, right? On the HEERF I reports. One of the data points was how much was allocated under HEERF I for student grants. And then there's another data point where it was, what was your plan for distributing those funds, right? So you had to describe that. Yep. I mean, it would seem to me that you want a report that shows you used all the HEERF I money. So I think you would still have to report it there, and maybe, in the section of the report, I shouldn't say maybe, I mean, again, as I'm thinking about it, I mean, this is the way I think you would have to do it, is that you would modify your distribution plan, right? So if you've changed how you're going to distribute the HEERF I student grants, that you would describe that under, I think it's like item 6 on the list, or I said item 6 or item 7 on that list of disclosures. But at the end of the day, I mean, again, if you've got $100,000 of student grant funds, for the HEERF I student grants, you want to demonstrate that you've awarded and distributed $100,000.
Yeah,
I think
that makes sense. That's kind of what we were thinking as well. And again, if you have a little additional wording on there, if they have the data points, if you put a little additional wording, clarifying this is how it's spent, and you also include that on your HEERF II, I don't think it hurts if you have additional documentation providing a clear trail for a department or anyone to follow as well. So
right. So yeah, the one thing with HEERF, I would say with HEERF III, if you're curious, I think there are some organizations online, or at least one I know, that has made an estimate. We don't have formal numbers yet. We haven't had a formal allocation yet from the department, but you may be able to go online and find out at least what some folks are estimating all the various schools are going to get under HEERF III. So just if you're curious as far as that going into your planning, it's not official, but at least gives you some idea.
Yeah, thanks, Mike and Chris, for all your thoughts today. It's been helpful. We'll work through some questions. There's clearly more that we can get through in 10 minutes, but I'll enjoy picking the ones I would least want to answer and asking them of both of you. So the first one is, can we claim rent if the students were online, but the campus was closed, so that we didn't have a loss of revenue during the period, but there were still expenses for rent and utilities with the building?
Okay, Chris.
So that was something that came up before this expanded use, because that was a big ticket item for schools. And as far as conversations about how are we going to use these funds, and the department hasn't really addressed that issue point blank. But they did address it verbally in a department webinar that happened back. I know it was before the election, so I know it was under the Trump administration. October. But they did talk about that issue, and I think the guidance from the department would support that general proposition. Now, there's of course the devil's in the details, right? So looking at if the thought process or the concept is, I had to pay for something that I couldn't use because of COVID, then it seems to me that there's a logical argument that would be in the lines of that's an expense related to coronavirus. But then you're getting into, well, what does it mean you couldn't use it? Is it the clinic? Is it the classrooms? Did you have people on site? When was it closed? Were you closed under mandate? So there's a lot of there's a lot of detail. I think you'd have to look into that, and so that's something where, again, quite frankly, I mean, I would look at lost revenue first, and I know some schools have claimed occupancy costs with their prior reports, and that's great. And again, I think that's a supportable position. Again, devil's in the details of making sure you've documented it, because it's not just, oh, I'm going to claim rent for April. Well, it's not quite that simple. You need to make sure you've got the support for that. And that kind of ties back to my comment before about, even if you've used all your institutional funds under HEERF I, I think it's still a good idea to do the lost revenue calculation, because if you've got somebody from OIG who doesn't think like Chris DeLuca and is questioning, any occupancy costs or something, to be able to say, well, we've also got these other expenses here. I mean, and we've also got the lost revenue, and the department has addressed that issue point blank, and so there's a lot more comfort, I think, on that piece.
I think the other thing too is I know some schools that aren't using all of it. They've closed off a section because of social distancing, or they don't need it because people are online, so only coming in for labs. So that could be something. I mean, this lost revenue guidance certainly shows some leniency from ED. There could be, now I've got this unused space, so it's not the whole building, but a certain space that you can carve out that would seem to be pretty supportable as one possibility. But I think it's unique to each institution.
Mm-hmm.
Hopefully I can combine a few questions together that people are looking for guidance for time frame when they could be calculating lost revenue, but may have also received the PPP. So from the spring of 2020, and also a couple of questions from institutions that maybe applied for round 2 of the PPP, and the timing of when you use the lost revenue versus those other funds.
So I see them as two different things. I mean, if you're going to claim lost revenue, I mean, I would start looking at March 13th through the end of your fiscal year. I mean, that's what the grant's for. So I think I would start with that period of time, because I don't want to, as my example, I don't want to be picking and choosing just months revenue was down and, throwing out months revenue was up again, especially if it's going up and down. If you had a significant loss and then you kind of righted the ship and got back to normal, that's a little bit different. You could pick the period of time where you really were struggling. To me, the PPP loan was to cover your payroll. And so I think lost revenue and the payroll loan could be over the same periods of time. What our example was, though, you don't want to claim payroll costs in your HEERF grant if you've also gotten the PPP loan for those same payroll costs. But the fact that the PPP loan and the HEERF lost revenue cover the same time periods, I think that's okay. The PPP loan was so you could maintain your staff and pay them. The HEERF, the lost revenue, is support the revenue decreases you had at this time frame. Those are two distinct items. So I don't think there's a problem if they're running on similar time periods.
Okay, thank you. A couple other questions combining just about claiming lost revenue either at a separate school that is non-Title IV, or including lost revenue from programs that are not Title IV eligible. Is that a possibility?
I'm trying. They don't have that exactly in the guidance. It goes back to the other Q&A about the non-credit, the non-degree programs. I mean, I think you could make an argument if that non-Title IV, obviously the money had to come into a Title IV school. I think one of the keys I'd want to support is that non-Title IV program location included in the 90/10 calculation? Is it in essence, because if part of the 90/10, you're saying this non-Title IV program or this non-Title IV is part of our institution. So if the Title IV money if that HEERF money came in, remember, it's not Title IV, it's HEERF money that came in to support the Title IV institution. If I don't see why the non-Title IV money or the non-Title IV school couldn't be used for that, because it's all part of one institution. That's kind of the take I've gotten on it, from looking, especially the expanded guidance. I don't know, Chris, do you feel otherwise?
I would agree, and just maybe emphasize the point that we're looking at these allocations by OPEID number, right?
Yep.
So it's not just location, and certainly if you've got a location that's non-Title IV, I mean, if it's not part of that OPEID, and then even if you've got multiple locations and you're doing a lost revenue analysis, that you need to be doing that at the OPEID level, right? So if you've got 3 locations that are all part of the same school, same OPEID, one, you can't just pick and choose which location. Oh, these 2 had lost revenue, and this one actually, for whatever reason, broke even, or had grew. You have to include them all.
Okay, great. I just want to be respectful of everyone's time. We're approaching 15 minutes after the hour. You can see the contact information here for Mike and Chris. Again, there were a large number of questions, which is great. We appreciate the interaction. It helps us to frame what we want to discuss. Certainly, you can follow up with any of us if you have questions or one that wasn't answered or one that you think is specific enough you may not even want to ask on a public forum like this. We're happy to review that with anyone. And just lastly, because there are a couple of questions related to it, we touched on it briefly. And as an audit firm, I feel like we need to comment on the new audit guide for the proprietary schools related to HEERF. Just to clarify, the earliest it would be due is, in essence, July 31st, I think, of this year. So
It might be July 29th if you
depends
do
how they count it. So
days,
it's the later of 4 months from yesterday when it was issued, or your normal compliance audit due date. So for a proprietary school with a 12/31, your compliance audit is due June 30th. You're getting 29 or 31 days, depending on how strictly they intend to enforce the 120 days. Just so people are aware, that question came up a couple of times.
And reminder that the $500,000 limit for the audit appears to be at the OPID level. So if you got less than 500, I think you're clear. If you got more than 500 but expended less, I think you also may not have an audit, because it's what you expended in the fiscal year. Remember though, in 21, HEERF 2 falls into that, along with any expended money you may be taking on lost revenue. So it is possible not to have an audit 1 year, but possibly have it the next year, because you could have HEERF 2 and 3 in 2021. Right. So.
And we will be releasing additional insights to the audit guide. So if you're not signed up already for our McClinic Minute updates, I recommend doing that, and we'll share that information with you when it's available. Last point of organization, just a reminder that we will be making a recording of today's presentation available, along with the presentation itself and the handouts, to everyone who made time today. And then in closing, just thanks again, Mike and Chris. I thought this was really helpful. Appreciate everybody who made time out of their day today. We know how busy schools are right now with everything going on, and we appreciate you spending some time with us. And with that, thank you very much and have a great day.
Thanks, everyone.
Thank you.
Thank you.